What happens when a business built on, the sizzling heat of summer sales suddenly faces the coldest summer in decades? Today, we're doing a deep dive into exactly that scenario. We're looking at the latest Q1 FY26 financial results of Aditya Vision Ltd, or AVL. They're a major consumer electronics retailer in India.
Yeah, and our mission today really is to unpack the key insights from their recent earnings call and their investor presentation. We want to go beyond just the headline numbers. You highlight how AVL didn't just survive this thing, but actually navigated these unprecedented challenges, and more importantly, what their approach tells us about their future and maybe the broader retail market too.
Absolutely. We've got a detailed transcript of their earnings call and their latest investor deck. And honestly, it's packed with fascinating details.
Yeah.
Okay, let's dive in. So Q1 FY26, that's April to June 2025, it presented just an extraordinary challenge for AVL. From that earnings call, what was the detail that really underscored just how severe this weather situation was for them?
Well, the thing that really jumped out was management calling it one of the most unusual summers in AVL's entire 26-year history. That's saying something. We're talking continuous rain, virtually no heat waves across their main markets, BR, Jharkhand, Uttar Pradesh. And get this, May 2025 was the coldest May in over 6 decades across India. Decades. The numbers themselves paint a pretty stark picture. Rainfall from March to June was way above average. Like Uttar Pradesh saw 198 millimeters versus an average of 145. Bihar got 223 against a usual 157. And Jharkhand, 215 compared to its average of 155. Just tons more rain.
Wow, that's a dramatic increase in rain. And the temperatures felt that too, right? They were way down.
Exactly. Temperatures were significantly lower. In UP, the average was 35.1 Celsius compared to a normal 37.6. Bihar was 34.8 against 37.7. Jharkhand saw 34.5 when its average is usually 36.4. So these weren't just small dips. They fundamentally changed how people behaved, what they needed.
Okay, so with that kind of drastic weather shift, what was the immediate, the direct hit on AVL sales and I guess the industry as a whole?
Well, it meant demand for all those seasonal cooling products just plummeted. ACs, refrigerators, air coolers, fans, everything. And this wasn't just an AVL problem. The entire industry felt it. OEMs, other retailers, they were reporting something like a 15% to 30% drop in primary sales for these categories. It really put a massive crunch on a sector that banks so heavily on those summer months.
Right, but here's the fascinating part. Despite those incredibly tough conditions, Aditya Vision showed, well, remarkable resilience. They actually managed to grow their revenue, didn't they? By 6% year on year to 940 crores. That's building on a strong Q1 last year, too.
Yeah, 889 crores last year. So growth against an industry decline. That's key.
And their profitability stayed pretty healthy. EBITDA margins held at 9.5%, that's 90 crores, and profit after tax even grew 4% to 55 crores. Gross margins ticked up slightly, too. So when you dig into how they pulled that off in such a rough quarter, what were the crucial moves they made?
It really came down to what they called internal discipline countering external softness, which sounds like corporate speak.
Yeah, a bit.
But it really highlights their agility, doesn't it? It wasn't just about cutting costs. It was about doing it smartly. Many companies might panic and slash everywhere, hurting service. AVL managed to pull back on discretionary spending ads, promos, warehousing, freight, security, while keeping the front-end service quality high. That suggests a really lean, efficient core operation, which is, frankly, a competitive advantage in retail.
And I think they mentioned sales bonuses and incentives naturally went down too, right? Because volumes were lower.
Exactly. That contributed to cost savings as well, sort of automatically.
Okay, so cost control was one piece. But how did they avoid getting buried under a mountain of unsold ACs and coolers when demand just vanished overnight?
That's where their inventory management really shone. It was quite agile. See, they had actually proactively stocked up at the end of Q4, anticipating a strong summer, which was smart. Initially, it helped them avoid potential compressor shortages and get early OEM discounts.
Right, planning for the best.
Exactly. But when the weather turned and demand just, well, softened dramatically, their teams reacted super quickly. They pushed selective sales with targeted promotions, and crucially, they got their suppliers, the OEMs, involved early to get support. This quick adjustment meant they slashed inventory levels by a hefty 150 cores in Q1 compared to where they were in March. And their AC stock, specifically, is now back to what they consider historically normal levels. No huge overhang.
So that's smart inventory handling and cost cutting. What did that mean for their balance sheet, their overall financial health?
It meant a much, much better capital position than you might expect. That efficient inventory liquidation plus solid receivables management and just disciplined buying led to a sharp drop in short-term debt. It went from 278 crores in March down to about 115 crores by the end of June. That's a big swing.
Wow, yeah.
Plus, they had a comfortable cash position of 141 crores and positive cash flow for the quarter. It's kind of counterintuitive, right? Seeing such strong financials after a quarter where your main seasonal products tanked really speaks volumes about their financial prudence.
Definitely. Now, on the earnings call, an analyst brought up the new BEE energy efficiency norms for ACs coming in January 2026. They were worried AVL might get stuck with old inventory they couldn't sell. What was the company's take?
Yeah, that was a good question. They clarified that AVL itself isn't barred from selling the existing stock after January 2026. The new rules apply to the manufacturers. The OEMs can't produce non-compliant models after that date, but retailers can sell through what they have.
Okay, so it's a manufacturing deadline, not a sales deadline.
Precisely. And what was really telling was AVL emphasizing how substantially supportive the OEMs were, offering things like free installations and other perks for customers. This meant, and they were explicit about this, that AVL did not have to resort to heavy discounting or fire sales to clear that AC stock.
Ah, that's huge. It shows a really strong partnership with their suppliers, a key competitive edge, probably.
Yeah, absolutely. That kind of relationship is critical.
Okay, let's shift gears a bit. Despite that challenging Q1, AVL kept expanding its store network. What's the strategy there? Are they still bullish on physical retail?
Oh, absolutely. They seem fully committed to their long-term expansion plan. They opened 4 new stores in Q1 itself, then another 3 just in July. That brought their total count to 182 stores by late July. And they're still guiding for 25 to 30 new stores for the full financial year, FY26. They expect to cross the 200 store mark by the end of the year.
And where are they focusing this expansion?
Their strategic focus remains squarely on the Hindi heartland. They're deepening their presence in central Uttar Pradesh, including Lucknow, and also pushing towards western UP. They're primarily targeting those Tier 2 cities, where organized retail often has more room to grow.
And you mentioned something earlier about their track record with store closures.
Right, this is quite impressive. They've had 0 store closures since they started the company. 0.
Wow, that says a lot about how well they pick locations and manage those stores. Sustainable growth.
Exactly. It suggests their store model is very robust and profitable pretty quickly.
Okay, let's talk same-store sales growth, SSSG. For Q1, it was negative 4%, which is obviously a big contrast to the positive 21% they saw in Q1 last year. But given the industry decline of 15–30% in cooling products, how did they manage to keep SSSG at only minus 4%?
That's a really important point. A relatively small negative SSSG, like negative 4%, despite that brutal summer, tells you a couple of things. First, other product categories, the non-seasonal ones, must have performed quite well to offset the cooling slump. Second, the revenue from their newly opened stores, which aren't included in SSSG calculations for a while, definitely helped the overall top line.
Right, SSSG only counts stores open for a certain period.
Exactly. And interestingly, even ACs, which were hit hardest, still made up about 42% of their total revenue in Q1. And AC revenue only saw a 2% degrowth for AVL.
Only 2%, when the industry was down 15–30%.
Yeah, it's far less of a drop than the overall market experienced. Suggests they gained market share even in a declining category, likely due to their strong execution and maybe those OEM partnerships helping.
Okay, so even the bad news wasn't as bad as it could have been, and management sounds confident about SSSG for the full year.
They do. They expect positive SSSG for the full fiscal year, FY26. They believe the upcoming quarters will more than make up for the Q1 dip.
It is fascinating how optimistic they sound for the rest of the year, especially after such a tough start. What's driving that positive outlook? What tailwinds do they see?
They're looking at several positive factors. On the macro level, India's economy is forecast to grow around 6.4% in FY26. That's supported by things like rising rural incomes, government spending on infrastructure, and generally improving consumer confidence.
Okay, general economic health helps. Anything more specific?
Yes. The union budget for 2025 included some personal tax relief, which is expected to put about 1 lakh crore rupees back into consumers' pockets. They see that as a strong tailwind for discretionary spending, especially hitting around the festive season.
Makes sense. More money, people might buy that new TV or washing machine. And anything specific to their core markets, like Bihar?
Yes, absolutely. In Bihar, there's a new scheme that started August 1st, offering 125 units of free electricity per month. They expect this to significantly boost demand for consumer durables and electronics. It frees up disposable income, obviously. But there's also a psychological effect, right? If electricity feels cheaper or free up to a point, you might be more inclined to buy things that use it.
Good point. And the good rains, ironically the cause of the Q1 slump, might actually help later.
Exactly. Good rains usually mean good harvests. In AVL's operating areas, which have a strong agrarian base, bumper crops mean more disposable income for farmers and related communities later in the year.
Okay, so a confluence of factors potentially boosting demand. When does that crucial festive season actually start this year? And what's the overall growth target?
The festive season kicks off a bit early this year, starting in late September. Management sounds very optimistic about it. They're sticking to their historical guidance of 20–25% sales growth for the full year.
That's ambitious after a flat Q1.
It is, but they're confident that the 40 to 45 new stores added over the last year or so will really kick in and help them achieve better growth in Q2, Q3, and Q4 compared to last year. Plus, these upcoming quarters are less dominated by cooling products, which, as we've discussed, cause the Q1 pain. So the product mix works more in their favor going forward. So maybe we should dig a bit deeper into the numbers and the business model itself, because that really explains the resilience and the potential for that kind of growth. Looking back, say, from FY22 to FY25, their track record is seriously impressive. Revenue grew at a 36% compound annual growth rate, hitting 2,260 crores in FY25. EBITDA was up 35% CAGR to 204 crores, and profit after tax, a remarkable 44% CAGR, reaching 105 crores last year.
Those are really strong TDHRs for retail. What about the economics of actually opening and running a store? You mentioned they break even fast.
Extremely efficient. The average capital needed to set up a store, the CapEx, is around 70 to 80 lakhs. Working capital per store is about 2.75 to 3 crores. And here's the key bit. The average store reaches break-even at the store level in just 7 to 9 months.
7 to 9 months? That's incredibly fast for retail.
It is. And the full payback period for the investment is just 3 years. That speed allows them to reinvest and fuel that rapid expansion we talked about. And looking at their costs as a percentage of revenue in FY25 gives more context. Gross margin was 16%, employee costs were super lean at 3%, rent only 2%, and advertising just 1%.
Wow. 3% for employee costs and 2% for rent is very low. Really highlights that lean structure you mentioned.
It does. It's built for efficiency.
Okay, that lean model seems key. What else is unique about how they operate? You mentioned supply chains earlier.
Yeah, a huge factor is that 85% of their supplies come directly from the OEMs, the manufacturers. By cutting out middlemen or distributors for the vast majority of their stock, they secure better margins.
Makes sense. And they don't do private labels, right?
Correct. No private labels. They focus on maintaining long-term relationships with over 100 established brands. This clearly helps them get that strong OEM support, like with the free AC installations we discussed. It's a partnership model.
And on the customer side, anything notable beyond just selling the products?
They definitely focus on the service aspect. They have specific initiatives like Aditya Seva, which is their one-stop shop for after-sales service, and Aditya Suraksha for extended warranties. They also have a loyalty program to encourage repeat business. It shows they're thinking about the customer lifecycle, not just the initial transaction.
And financing seems important too. You mentioned a figure earlier.
Right, around 43% of their sales in FY25 were financed. Offering easy financing options is crucial for making higher-priced durables accessible to more customers. And just to round out the financial picture, they constantly emphasize their net debt-free balance sheet, a cash-and-carry model mostly, efficient inventory turns, and holding substantial cash reserves. Very financially conservative, which helps weather storms like Q1.
Okay, putting this all together, the lean model, the OEM relationships, the fast payback, the expansion strategy, what's the bigger picture opportunity here? Why is a company like AVL potentially so well positioned, especially in that Hindi heartland region?
Well, the fundamental opportunity is just massive, really. You have to remember how underpenetrated India still is for consumer durables compared to many other countries. Think about it. AC penetration is maybe only around 10%. Refrigerators, maybe 5–10% in some estimates. Washing machines, around 13%. TVs are higher, maybe 35%, but still lots of room. Water purifiers, around 74%. This low base means there's enormous headroom for growth as incomes rise and aspirations grow. What was once a luxury becomes a necessity or a standard household item.
So a huge potential market overall. And how does their specific focus on Bihar, Jharkhand, and UP play into that?
That specific regional focus is very strategic. Those 3 states alone account for roughly 30% of India's population. That's a massive consumer base. And crucially, these states are experiencing rising prosperity. We mentioned UP targeting a $1 trillion economy because per capita income is growing fast. The whole region is gradually shifting from being primarily agrarian towards more manufacturing and service-based economies. That creates wealth, boosts incomes, and fuels demand for the very products AVL sells.
And there's a shift happening within retail itself too, right? From local shops to bigger chains.
Exactly. That's perhaps the most important structural trend benefiting AVL. The Indian consumer durables market is rapidly shifting from the unorganized sector, think small local shops, towards organized retail chains, like Aditya Vision. As an established, trusted, organized player with those deep OEM ties, a proven store model, and strong brand recognition in their regions, AVL is perfectly positioned to capture a large slice of that shift. They're not just riding the wave of overall market growth, they're actively taking share from the unorganized segment. It's a double benefit.
So wrapping up, Aditya Vision's Q1 FY26 results really paint a picture of remarkable resilience. They faced these unique, really quite severe weather challenges, but demonstrated strong operational discipline and stuck to their clear growth strategy.
Absolutely. Their strategic focus on that underpenetrated Hindi heartland, combined with a very robust and efficient business model, strong OEM partnerships, it all positions them very well to capitalize on India's evolving consumer story, especially as prosperity grows in those key states. They've shown they can build a model that can, weather unexpected storms.
It leaves you thinking, doesn't it?
Mhm.
Considering that huge untapped potential in India and this big shift from unorganized to organized retail, what really defines a successful quarter for a growth company like this when massive external forces like the weather are completely beyond their control? Resilience itself. What really stands out to you from this deep dive?